Now we will take a moment to introduce you to our speakers. Stephen Gibson is a principal in Ann Arbor with extensive knowledge of financial planning and the many facets of qualified and non-qualified retirement plans. He develops creative strategies that help clients work toward meeting their financial goals, integrating retirement plan design, consulting, and administration and investment advisory services with overall business and financial plans. He works with a cross-functional Raymond team to proactively guide each client, considering tax law inefficiencies, estate planning, and accounting needs along the way. Chris Veenstra is a co-president of Watkins Ross in Grand Rapids. He is a fellow in the Conference of Consulting Actuaries, an associate member of the Society of Actuaries, an enrolled actuary, and a member of the American Academy of Actuaries. Chris has been providing actuarial services for both private companies and governmental employers since 1991. Stephen, you may begin the presentation.
Thank you, Ashley. This is the first webinar that I've ever been a part of that uses the word potpourri in the title. I have a second grader and I can only imagine her disdain if she brought that home as one of her spelling words. To get things started, we'll have a quick polling question, get one of those out of the way right away, and then we'll dive into the presentation. The results are coming in. It's been almost 30 seconds with the vast majority, 60% saying it's an engaging way to build a connection with the audience. In past governmental webinars, the focus has been on a variety of topics, but it's yet to really dive into the aspect of governmental retirement plans, and more specifically on defined contribution and deferred compensation retirement plans. The object of my presentation is to help highlight some of the fiduciary concerns on these plans, some of the differences between the plan's design, setup, and best practices, and some practical application, given that many different 457 and 401A plans are using multiple vendors. As we go through here, we'll talk about best practices, starting out with looking at what is a fiduciary. When people think fiduciary, a lot of it comes around to ERISA, which of course is not applicable for governmental retirement plans. The most basic form of a fiduciary is just someone that has control of somebody else's assets for the benefit of that other person, right? So just given the fact that we're here and we have control over these, what we're offering as far as on the deferred and defined contribution plans, there are fiduciaries on these plans. And while ERISA points out and gives a very precise or a specific definition of what is a fiduciary or who is one, state law also has a similar set of standards. In the example here, we're looking at Michigan. Every state is different, so if you are listening from another state, please look into your own law to determine what fiduciary obligation or responsibility you may fall into. But ultimately, for a retirement plan, it's anyone that exercises discretionary authority or control in the assets of the plan. And when you take a step back, this can flow into a variety of different positions. If you're in a position right now where you have the ability to determine what provider or record keeper is used, in a position to where you're saying if an investment change should be made, if you're in a 401A or 457 meeting in which these things are being discussed, you more than likely are falling into this fiduciary capacity. The other side of it is someone that's rendering investment advice for compensation. So this is where someone like myself, who's fulfilling an advisory capacity, outlines my fiduciary status. For your typical pension plan, these roles are often very laid out. You know who is the fiduciary, you know who's the advisor, who's on the committee, the board's responsibilities, there's an investment policy statement. There's a lot of framework surrounding pension systems. Right? When we switch over and we think about these other plans that are often referred to as voluntary or supplemental, these 401A or 457 retirement plans, they're not getting nearly the level of responsibility or framework put around them that is outlined in this case, Michigan PA 314. So part of the goal of going through here is we'll talk what should you be doing on these types of plans. And if you are not a fiduciary, if you're listening to this presentation, and ultimately a lot of the things that which we say may not be directly applicable, but it is very indirectly applicable, given that there's a high probability that you may be a participant or be eligible to participate in one of these plans. As we go through here, keep in mind what is applicable to me as a fiduciary and what is applicable to me as a plan participant. So take a step back, look at your role and determine, am I in a position to where I could impact or influence our 401A or 457 retirement plan? And if so, oh shoot, it sounded like you may be a fiduciary, what do you need to do? There's not a specific rule book as far as what exactly needs to be done if you are a fiduciary. ERISA goes out and they have a very broad terminology. And the reason why we talk about ERISA here is because all of these state laws, many of them were designed to work in a very similar fashion. And for example, Michigan PA 314 says, as an investment fiduciary, you're required to act in the same care, skill, prudence, and diligence under a prudent person. So what would somebody that's an expert be doing? And that's essentially how you're expected to act. In addition, it does outline that there should be written objectives, policies, and strategies with who's doing what inside of the plan. So there is a fiduciary requirement on these 401A and 457 plans. Polling question number 2. I'm not seeing anything come up, Ashley.
I'm actually getting an error message, so I think if you keep moving on, I'll just launch it if I can figure that one out.
Okay. The polling question is, are you a fiduciary, yes or no? And that will be if she can't figure it out. Next, we're going to go over to fiduciary best practices. Inside of a retirement plan, there are a lot of different roles and responsibilities. 5 major ones are outlined on this chart. These roles can be all taken by one company or perhaps 2 or 3. So the first step in becoming a good fiduciary to your retirement plan is understanding the role that everyone's playing in the plan. Who is the record keeper of the plan? Is there a separate TPA or third-party administrator? Do you have an investment advisor? This is a big one in that in a lot of governmental retirement plans, while there's a vast majority of the time there's going to be an investment advisor on the pension system, there are many, many times in which there's not necessarily a specific dedicated investment advisor on 401A and 457 plans. And what this does is it places a higher fiduciary burden on you, the fiduciary, to do the investment search, selection, monitoring, etc. So as we go through here, and the terminology that we like to use is bundled or unbundled. If you're working with a setup that's fully bundled, you're essentially having one company doing all of these roles. Whereas an unbundled setup, you're using multiple different vendors to fulfill these services. So again, thinking about practical approach, think about your own plan that either you're a participant of or that you're a fiduciary of, and see if you can determine the role that each party is playing. Inside of these investment choices, so the major difference between your typical pension plan and your 457 plan is that your 457 or your 401A plan tend to be participant-directed plans, which means the participants get to decide how they want to be allocated, and it's up to the plan sponsor to determine the listing of funds that should be offered in the plan. When we're looking at the record keeper's capability and the setup of your plan, there are providers out there which operate in a closed manner. So this would be on the left portion of your screen, in which they're offering a set lineup. There is not the ability for you as a plan sponsor to influence or change the investments that are offered in the plan. So that would be on the more simplified, the more reduced workload side. Where if you go to the other side on the far right, open architecture, this means there are tens of thousands or 10,000+ of different investment options out there. It's up to you, the plan sponsor and the investment advisor, if you're working with one, to determine which 15 to 30 funds of that larger pool should be offered to participants. Obviously, with open architecture, you have access to a greater amount of choice, potentially better results, potentially not, depending on investments that are selected. But with that comes increased complexity. So there's a fine line, and in the middle are providers or record keepers that offer some flexibility. You're working off a smaller list, but it's not completely closed or it's not completely open. Next, we're looking at fees. Fees are extremely important, especially in participant-directed retirement plans. A participant in a pension plan doesn't necessarily care what the fee is in the retirement plan, since they're being guaranteed a specific end result. However, on these participant-directed plans, the fee can have a major impact on whether they're successful or not. So here we look at a few different structures. One being an indirect fee payment method, and there'll be an example of this in future slides. But this method tends to be where compensation is coming from the funds, the expense ratios of the funds, and being paid to the provider. It's not directly deducted from plan assets. And what this does is it typically prevents the participant from fully understanding how much he or she is paying in fees for the various services. So that would be the indirect manner. It's typically not as transparent, and sometimes there's even issues with it not being equally split, because some funds are sharing more money than others. And we'll go through an example of that here in a little bit. And on the right-hand side, we're looking at direct fees. This tends to be the most transparent. It's very easy to make them equally split. And the issue with this is it allows participants to see fees on statements. Oftentimes in our industry, you might hear or read headlines that your retirement plan is free or your retirement plan is incredibly expensive. Well, that has to do with really the same aspect of not being able to see the costs. And oftentimes when you're not able to see the costs, they can be high. But when you don't see the cost, participants tend to think that there isn't one. So we tend to prefer a direct fee structure over an indirect fee structure. The hybrid box in the middle is really looking at the ability to split the fees, having some payments coming indirectly and some coming direct. So some flexibility from the plan sponsor's point of view. The investments that are offered inside their retirement plan, I mentioned earlier, typically we're seeing 15 to 30-ish being best practice. Where things become a little bit more complex is the type of vehicle that's offered inside of a retirement plan. More likely than not, when you think about your retirement plan, you're thinking of mutual funds being able to be invested in. Depending on the setup of your plan, it may not technically be mutual funds. It could be separate accounts or even collective investment trusts. And these are ways in which you can get a more custom fee structure around the fund, essentially to have that either that indirect compensation method, or if you want to strip it out and try to make it as low cost as possible. So depending on what provider you're using, you could be using separate accounts, you could be using mutual funds, or you could be using collective investment trusts. White label funds are typically reserved for billion-dollar plus retirement plans that can go out and really get custom pricing. On the far left-hand side, brokerage. So what we see here is there's some providers that will have a core menu of funds, 15 to 30-ish, but then they'll also offer a side door or a self-directed brokerage account. Participants can go into this door, open it up, and have access to thousands of different investment options. The key here is that it's very important to stress or point out that from a participant perspective, no due diligence is being done by the plan sponsor, by any investment advisor. It's a swim at your own risk. More often than not, we don't see the brokerage link. However, there is a time and a place for the right plan to offer that to participants. Next, let's focus on really the composition of the committee. So the composition can vary widely. It's typically not one person. It's typically not an even number, but 3 to 5 people. A lot of organizations will bring in leadership from various groups to serve as a sounding board for ideas. It tends to be really long-term people. This is not something where you want to have a rotation for a year or two come in or out. As you lose some of the history and some of the rationale or due diligence, the background that has been done over time. The biggest thing from a fiduciary perspective is making sure that everything is documented. So when you do meet, every decision that you do have, every time you look at an investment option, there should be documentation being done. Again, on the pension side, when you're looking at those plans, those tend to be much more buttoned up. When we're looking at 457 and 401A plans, there are times in which there is no committee. There's not any real identification of who has the authority. There isn't a set schedule of meetings. There's no documentation as to who's performing what role, and it's much, much more loose. And the starting point for anyone on the call that thinks that they might be in this position is to identify who has the authority. And if it hasn't been given out, it could be the board, it could be a commission, it could be someone that doesn't even have any involvement with the retirement plan. And when we go to those groups and we say, did you know that you're responsible for the operation of this plan and making sure that it's done prudently? That's the last thing that they want to do. It's not their highest and best use of time. So it is, let's form an official 401A 457 committee. Let's give them authority for specific purposes, and let's document it. Let's set up meetings. Meetings will typically be on either a quarterly, semi-annual, or annual basis, depending on the complexity of the plan. It's encouraged that at least one of those meetings you're bringing in the provider so they can go through their demographic report, talk about the plan health, give them a chance to talk about their new capabilities, as well as talk about education. So participant education is one area where it's done much differently on the governmental side. there's more focus on education on the governmental side. A lot of providers will have multiple employer-employee education meetings. They will sit down, they'll do one-on-one guidance with participants. But it's making sure that you understand who is giving the education and determining if that's most appropriate. There's a really big difference on education versus advice. Education is providing, general information about the plan, general information about risk, helping to point out where they may or may not be taking enough or excess risk based on their age. But ultimately, it is not financial advice. Giving participant advice would be, I want you to sell fund A and buy fund B. For the most part, your advisor or your record keeper, when they're doing education, do not give advice. There are a few providers out there which do. It's important to understand, are they giving education and are they giving advice? If you have a participant come to you and you're on the committee, or we're just working for the municipality, refrain from giving advice to participants. The last thing that you'd want to do is become a fiduciary at a participant level. Then you're essentially responsible for the decision that that individual participant decides to do. Switching over and continuing the discussion on participant education. A lot of the participant education in the past has been very, very simple, as far as very routine. A lot of it tends to be, let's try to get people to join the plan. Let's tell them they need to save. And that's our main goal, is we just want to get them into the plan and make sure that they're comfortable. There's been a lot of evolution in retirement plans and education, where we're starting to shift away from this concept of save 15% of your income, join the plan, and everything will be good, into more targeted type of education meetings. So we'll have a meeting for an age 50 plus group, this near retiree session, which we're talking about withdrawal strategies, optimizing Social Security, Medicare, long-term care planning, and focusing on what really matters to the participant. This tends to have a much better result or reaction from participants than your standard education meeting. It's also very important to outline what you're trying to achieve for the plan. If you have a pension system and you have this separate 457 plan, and you're still titling it as voluntary, you may not have a strategic vision of what would be a successful makeup for the 457 plan. It's out there. If people use it, great. If people don't use it, well, that's fine too. We're checking the box, right? That would be, a more hands-off approach. And it's not necessarily right or wrong, but a different view. And then you can also be much more engaged, to where you realize that the pension system or the pension plan or the 401A plan may not be enough to fully replace that participant's income. And so this 457 plan becomes a really vital part of a successful retirement strategy. And you want to take a deeper look at it and decide, are my plan participants, are the employees of the organization overall on track? And outlining those goals, and then aligning the education strategy to help meet those goals. If you determine that there's some area of weakness, let's make a plan and try to achieve it. We're going to spend the next 15 minutes or so talking about a best practice application. So we talked about very high level, some things which you may want to look at with regards to the investments, the fees, the setup, the architecture, the education. And now we're going to dive in and look at a scenario, a real life scenario of some things in which this particular plan would want to consider doing or changing on an ongoing basis. Oh, we have another poll first. I was a little nervous at first. I thought the scale was flipped around. 1 being the lowest. There is a handful of those, which is perfectly acceptable. It's a very complex topic, and a lot of it doesn't get enough coverage. There's not a lot of education provided on these types of plans. The winner was right in the middle at a 3 of 33%. It was a nice bell curve. And 2 people out of the group are the experts coming in at a 5. But 3 and 4 being the majority. And this is really, the goal of today is not to make everyone a 5, realizing that there is a lot of information here. But let's try to bump you up to the next level. Let's get 2 or 3 items that we can have as a takeaway, which you can go back and either look to implement or discuss, or bring up to the appropriate person that's in charge of the plan and say, hey, I sat through this webinar where they talked about how our fees are being deducted and who our providers are. Can we talk about that? What are our fees? Who are our providers? So here we're looking at a scenario in which it's a local municipality. They use 2 different service providers for their 457 plan. So it's extremely uncommon in the corporate world to have 2 different providers operating inside of one plan. However, if we flip over and we look at the governmental side, 457 plans especially, there are multiple times in which there will be multiple carriers or vendors inside of one 457 plan. So you might have one that uses 2, you might have one that's 3 or 4. And when the participant comes onto the plan, he or she gets to decide whether to put their money with provider A or provider B or provider C. And it puts a lot of strain on especially the HR and accounting are the people that are in charge, because oftentimes the participant says, well, which one, right? And that's the last thing you want to do is be giving advice on which provider to use, and you may not fully understand the providers to begin with to make that accurate decision. The other issue of having multiple providers in a 457 plan is the duplication of work. So you as a fiduciary need to do due diligence on each record keeper, on each investment option, on each cost structure, benchmarking the cost. The plan design could be different between the 2. So now you have to know 2 different types of plan design, and it becomes very burdensome. So this scenario that we looked at is if you're in one of these predicaments where you're using multiple 457 plans, best practice is not necessarily to consolidate and combine them all into one, but it's to do the due diligence, saying what are we leaving on the table if they are put together? What do we need to consider? And ultimately decide yes or no, is this something that you want to do? If you're working and you have the same provider on your 401A and 457 and it's just one, that's great. That's considered best practice. Avoid bringing another 457 provider in at all costs. You might have an instance in which your 401A provider and your 457 provider are different. And there it becomes much more cumbersome because as a participant now, I would have to go in select the options that I want on providers A, website, but then in provider B, it's a completely different set of options. And I have to log into each one. I have to assign 2 different websites for beneficiaries, and it's much more cumbersome. There's not one spot to view all the information. So that's another time in which you may want to look at consolidating or using one service provider. So in this example that we'll be walking through, 2 different plans, one with 1 million of assets, one with about 2.3 million. The higher number of plan participants are using the plan that's smaller in assets. That's just the way that this particular one broke out. And both using 17 investment options. But as you'll see, 17 that are distinctly different from each other. Yellow text here, yellow highlights, indicate that it's a provider A investment, where no yellow highlights indicates that it's in the other plan. And the issue that we see right off the start is there are some spaces of the market in which there is only funds in one plan. Like, especially in that top 3x3 box, there's 3 different spaces in which there's a Vanguard index fund in one plan and no asset or no fund in the other plan. Now, your role as a fiduciary is determine what funds should be offered in the plan. And it's hard to argue because there are mid-value and mid-growth funds available in the other plan, but it's hard to say, well, in one plan, we think a mid-cap growth fund is a good option for participants. It's a good space of the market. We want to have an investment option. But the other plan, I don't think it's a good idea to put in a mid-cap growth spot. So we're not going to have an option there. Now, most of the time, these menus are either pre-designed by the record keeper, or you're using different advisors or brokers, so you're getting different information. But as fiduciaries of the plan, you really have to look at them both together and saying, are we operating each plan consistently, right? Are our thinking going on to each plan in a similar manner? If we look on the very bottom right-hand box, in the other section, one plan offers real estate, one plan offers emerging markets, right? But it's not flip-flop, not the other way around. So that is an issue in which we're seeing here. Overall, the coverage of this particular one looks good. On the left-hand side in the middle, under money market stable value, both of these plans are using a money market fund. So here we're looking at, does a stable value fund or a fixed account make more sense than a money market fund, and doing the due diligence. Another interesting thing when we looked at this plan in a little more detail is there's, under provider A, the green pie slice in the bottom is a lot larger than the green pie slice under provider B. And these looks at target date funds. And you would think that there would be a pretty equal split in the asset allocation from one plan to the next, just given that it's a somewhat random decision of who's choosing provider A versus who's choosing provider B. And here we see that one provider looks to be promoting a lot higher use of the target date funds. So perhaps their education is more geared towards describing the benefits of target date funds and having participants see the value in those, right? Not to say that that's right or wrong, but that maybe that's what it is. Whereas the provider B, just given that there's hardly anything in target date funds, perhaps that should be better explained to participants as an investment option, making sure that they understand how they're structured, because there may be some participants that would like that. So here's just pointing out the differences is, especially on the education side, between 2 different providers across the same group of people. Next, we're looking at diving into the target date funds a little bit deeper. So back in 2014, the Department of Labor put out a little pamphlet on tips for selecting target date funds. not rules, not regulations, but just things you want to consider when you're selecting these investment options. Now, target date funds, if you're unfamiliar with how they operate based off of a glide path, which is what is on the left-hand side of the screen. You'll see that right at the start of the glide path, the line is very high up, indicating that there's a substantial amount of risk in the funds. And that's because you have 25 to 40 years until retirement. So you need that, the higher equity allocation. Then we see that line start to slide down as it approaches that vertical dotted line indicating retirement. So over time, the fund itself automatically becomes more conservative based upon the age that's chosen. Oftentimes when we meet with participants, their biggest thing is tell me what I should do, right? They're really looking for as much guidance as possible. And this particular option helps to answer that, just given a one fund that's diverse, that changes based on an age. When you go to select those, what happens a lot of times is whatever the provider has in their initial booklet or suggestions is what's being adopted. And a lot of times it's proprietary. So that's whatever fund company you're using or your record keeper, it's their own target date funds inside. Here you want to choose a fund that aligns with the risk level of your participant base. So as part of your meetings, you want to make sure at least one meeting a year, you're looking at the target date glide paths and making sure that it's appropriate for your base. If you have a very conservative participant base, or if your pension benefits are so luxurious, you may not need such an aggressive glide path, right? And you might opt for a more conservative one. But again, do the due diligence and document it as you go. Looking at performance rankings, these charts use the concept of peer ranks, to where the number that is listed, it's like golf, the lower the better, and it looks at the fund rank in relation to other funds that are doing the same thing. So if we look at the very first fund on the upper left, Vanguard Target Retirement 2015, this is being compared against other 2015 target date funds. The 91 for the 1 year column indicates that it underperformed 91% of other 2015 funds. We highlighted anything in red just as an indicator of falling below the 50th percentile, so underperforming the average peer. You as a fiduciary, you should be able to articulate or understand the performance of your funds. A lot of times you as a fiduciary are only looking at the absolute performance. You're seeing, oh, Vanguard Target Retirement, I'm going to make up a number here, return 10% over the 1 year period. That's great, right? But then you uncover the story a little bit more, and then you find out that its peer rank isn't the best. And suddenly that absolute return number doesn't mean as much as its performance related to peers. So we like to look at peer performance. I would encourage you, if you are doing any due diligence in your plan, if you are a fiduciary, ask for that peer rank number and see if it's captured, and use it as just another data point in your decision-making process. Red doesn't necessarily mean bad. What it means is there should be additional due diligence done, additional documentation done as to why that fund is still appropriate for the plan. One fund that's about halfway down on the left, Harbor International Institutional, falling in the 83rd percentile over the 10-year, so outperforming 17% of its peers over the past 10 years, underperforming 83%. There was a really good manager on this fund that passed away 11 years ago, and the rest of his team took over. So that would be one in which you might say, okay, is this really appropriate or not? I can't make that judgment over the webinar, but you would want to have documentation that outlines that. Next, we're going to focus on fees. So fees can be paid a variety of different ways. The plan sponsor can pay them directly. This is very unusual for a municipality or a governmental organization. The vast majority of the time, it's one of the 4 circles on the right-hand side. So either directly by plan assets. So that would be that direct fee structure that's going to be transparent and equitable, considered best practice. The other three are all coming from different areas. So your record keeper or advisor could be paid from the investments in the plan. Your investment advisor could be paid from the plan provider. Your plan provider could set up a plan expense account, put money in the plan expense account, and then the advisor deduct the cost from the plan expense account. So there's a variety of different ways in which these fees are structured. And you should be able to articulate, the who, what, when, where, why, and how of fees. Who's getting paid, how are they being paid, what's the level of compensation, how frequently are they getting paid, and answer a variety of other questions as it relates to the cost of the plan. Here we look, and this is looking at one of the plans, the smaller $1 million plan. I added this slide on here to look at the second column from the right, titled revenue sharing. So in this plan, it's that indirect compensation that's coming from the investment options that's going back to the plan provider. Some funds have 0, some funds have 35, right? That Pioneer fundamental growth, that's about 8 or 9 funds down. So depending on where participants are investing, they might be paying a higher or lower cost or burden of the admin costs. And is that fair? Not necessarily right or wrong, but whatever reason you choose, you should have documentation as to why you feel it's the most appropriate. In this case, provider A and provider B, we'll focus on the the blue lines at the bottom of the table as the all-in costs. So this would be 2 different plans, 2 different providers using 2 different advisors. One plan was at 1.17%, the smaller plan, and the other $2.3 million plan is at 0.95%. So here, as we expect, the plan that's a little bit larger with a little bit less participants is less expensive. That would be going to show what economies of scale can bring to the plan. So what we did is said, if these were together, how would they be priced? And ultimately, and I'll explain this slide briefly, and then we'll work on wrapping up, where the plan costs were 1.17 and 0.95, if they switched to one provider, right, having one set of investment options, using having one due diligence meeting on each provider, knowing the cost structure of just one provider, having an education strategy to where you're leveraging and having a partnership with the provider, a ton of benefits. The total fees is the first column on the left under the purple bar. If you go down to where it says 0.70. So that's actually what the cost would be if these plans were consolidated into one. So here we're looking at one plan being 3.4 million in assets and 52 participants. So given all the benefits and the reduction of cost, again, there needs to be some documentation as to why it's still prudent to offer 2 as opposed to just offering 1. And you may say that having 2 is more participant education, flexibility. There's a variety of things which you can come to that conclusion, but ultimately it's doing the due diligence and making sure. If you're already operating under one plan, you still want to go through a benchmarking exercise like this to where, this particular report is looking at 579 other plans between 2.4 and 4.5 million of assets, and it's breaking it out by service provider, the cost of each service provider, helping you as a fiduciary, ascertain that, or make known that fees are reasonable for the services provided. That's one of your fiduciary responsibilities. Polling question number 4. And after this question, we'll be turning it over to Chris. We have 30 seconds left, and split between here for the CPE credit and interested in developing knowledge on retirement plans. So that's great. If you do want more information, feel free to reach out. And with that, I will turn it over to Chris.
Thank you, Stephen. He set the table nicely. I might also add that I think I saw a note saying that because there were problems with the polling questions, you'll all get full credit. So I don't know if that means I can finish in 15 minutes, but we'll try to keep it honest. I need to see if I can get control here. I thought I was gonna. There it is. So what my role is in today's presentation is to talk about defined benefit plans. And if you are a defined benefit plan sponsor, then hopefully what I have to say will help you understand your plan liabilities in relationship to your plan assets. How are those connected, and how does the plan liability that you see in your reports inform the decisions you make as fiduciaries with respect to your assets? Now, I just assumed for a second there that you were fiduciaries if you had a defined benefit plan, but your DB plan might be with MERS, in which case you still would want to understand these topics, because it will allow you to ask MERS informed questions. Even if they have assumed the fiduciary responsibilities for you, the better the questions you ask them, the better informed you'll be with respect to your plan, and be able to judge whether or not your plan is on track to provide what you need. If you are neither of those, you're not a defined benefit plan sponsor, or you're not a defined benefit plan sponsor that utilizes MERS, and you are just in a defined contribution plan, I would like to think that this would also be helpful for you on that score as well, because there are some crossover principles between defined benefit and defined contribution plan investing, and I will try to connect those dots as we go through this. So one more comment in connection with defined benefit plans and defined contribution plans. Oftentimes when we ask a defined benefit plan sponsor, what is your main frustration with your defined benefit plan? Or put another way, how come you like your defined contribution plan better? Oftentimes the response will be something along the lines of, in a defined contribution plan, be that a 401k or a 457 plan, 403b, I know what I have. And that's great. It's like getting in the car to go on a trip, and somebody says to you, what's in your suitcase? Well, let me tell you, I know exactly what's in there. I have in there a winter coat, I have a long sleeve shirt, and I've got a nice pair of jeans. Well, that's only half the question. What do you have? That's all well and good. But the other side of the question is, what do you need? If that person were headed to Florida in the middle of the summer, so what? If they had a nice winter coat, long sleeve shirt, pair of pants, that's not going to do them a lot of good. Furthermore, they're going to be gone more than a day, or in some people's case, more than 10 minutes. That's not sufficient. You need to know not only what you have, but how much you need. And defined benefit plan actuarial valuations are intended to answer that question. How much do you need? What do you need? And I'm still not getting this to advance, even with scrolling. Is there something?
Try to click on the screen and then move again.
And then do it. All right, thank you.
Yep.
All right. So I know what I need. I don't know what I have. So here is an example. Plan A has a liability of $4.1 million, as does Plan B. Plan A has assets of $3 million, as does Plan B. They both are underfunded by $1.1 million, and for a funded percent of 73%. And I've got, so I point out, same liability, same assets, same funded percent. Before we move on to the next slide, I will connect this to my comments about what you need. The actuarial valuation is the process by which that liability number, that $4.1 million, is determined by your actuary. The liability is a measure of where your assets ought to be at that particular point in time. So drawing a connection to or a parallel to a defined contribution plan, if somebody said to you, how much do you have in your DC plan? You said, well, I have $3 million. That's great. How far along should you be? Is that $3 million good for your retirement goals? And when you see commercials many times from Principal or some of these other financial advisors, the implication, if not the outright question they ask is, do you know if you have enough? Do you know where you're at? Do you know what you need? That's in effect what they're trying to answer for you. And so that's what the liability is in a defined benefit plan actuarial evaluation. It is a measurement of where you ought to be in terms of your funded progress. So just glancing at this right off the top here, you are not where you ought to be. Your funded percentage is only 73%, and you ought to be 100%. It's something we'll look at in a little more detail in a second, and this is not really the point of this presentation, but I would want to point out that if you were 100% funded and you had $4.1 million of assets, would you be done paying for your plan? No, not necessarily. This is where you ought to be in your accumulation of money by the time you retire. This is only one step along the way. Any future assets you might need between now and retirement still have to be contributed. And so the actuarial valuation is designed to answer that question as well. Now, again, that's a discussion for a whole nother time in terms of how to use the actuarial valuation for funding decisions. This is more, how do you look at your actuarial valuation to guide your investing decisions? So moving to the next slide here. Are these two plans situations the same? How might they be different? I've already alluded to the fact that they're both, outright said they both are the same funded percentage, 73%. They both have $4.1 million in liability and $3 million in assets. But does that mean that these plans are equally well funded? It would appear to be the case, but questions that one ought to consider is, what are the actuarial assumptions that are being used to determine the liabilities? In particular, for this discussion, what is the expected return on plan assets? If Plan A's expectation were 10% return on plan assets and Plan B's were 4% assumed rate of return on plan assets, which one has a better chance of meeting its goals? Just anecdotally speaking, I know that the market return has been great for the last couple of years, but a 10% annual return on investments is not very reasonable, in which case I would say that that 73% funded status under Plan A is not all that pertinent or valuable piece of information. Whereas under Plan B, to say, oh, I'm only assuming a 4% rate of return on plan assets, given that assumption, I'm 73% funded, there's a good chance your assets will meet your target return of 4%, if not better, depending on how they are invested. One other question you ought to consider when you're looking at your actuarial valuation report and you're looking at your funded status is to ask the question, are the asset values shown market or actuarial value? An actuarial value of assets smooths gains and losses over a select period of time. Here's an example. Here's an example of a smooth actuarial value of assets. The market value, as you see, is $3,045,000. During the current year, it returned $150,000 above what was expected. That's an asset gain. Year minus one, it returned $120,000 less than what was expected. Now, that doesn't necessarily mean that the fund returned minus $120,000. An asset loss of that size means that it returned $120,000 less than expected. So if you assumed 10% return on your $3 million and you assumed 300,000, but you only got the $480,000 return, or I mean, excuse me, $180,000 return, that's $120,000 loss or less than expected return. And again, in our example there, year minus two, we see $30,000 less than expected. Now, I'm not so concerned that you follow the math here, but rather the gist of it being that in a smoothing method, you don't recognize, in this particular case, all of the gain or loss in the year in which it occurs, but you recognize 25% of it every year. So the one in year minus two, you have recognized 75%, and you're going to defer 25%. Yeah, one more year of deferral. Year minus one, it's 50-50. You recognize 50%, you have another 50% to recognize and or to defer. And the current year, you're only going to recognize 25% of that $150,000 gain, and you're going to defer 75% of it. So the math of those shows a deferred gain of $45,000, which is then subtracted from your market value. So you have an actuarial value of $3 million. Again, don't focus so much on the math, but the idea being that you are spreading your gains and losses over some period of time on your market value of assets, and you're not recognizing it all at once. So the question you'd want to ask if you have an actuarial valuation is, are the assets market or are they actuarial? And if I were to tell you that both of those plans that I showed you, A and B, used an actuarial smoothing method over the same period of time using the same method, are you now comfortable claiming the two situations are the same? Well, here are assets for plan A, $60,000 loss in year minus two, $60,000 gain, excuse me, in year minus two, $60,000 loss in year minus one, and a $15,000 gain in the current year. And we apply our deferral factors. Plan A, it turns out, has a market value of only $2.996 million, but we're not going to recognize $3,750 of loss that occurred. So we add that back into the market value. So we have an actual value of $3 million. For plan B, that was the one we just looked at. The market value is $3,045,000. We had a deferred gain of $45,000, which we aren't yet recognizing. So our actual value is $3 million there. So both plans have $3 million in actuarial value of assets, but their situations aren't quite the same. And now getting into asset and investment management, understanding what your assets are in, we would ask the question, what situation would you prefer and why? Well, if I look at this, I think, this one here has a market value less than $3 million. That means that I have yet to recognize I'm going to pick up over the next several years, $3,750 of unrecognized losses. So maybe I don't like that situation. So I look down here and I think, oh, my market value is bigger than my actuarial value. So yes, I like situation B better. But take a look at these gains and losses. In plan A, that's pretty stable. 60,000 out of 300,000, you're looking at missing your target by under 2%. Missing your target by under 2%. And here, missing your target by just under 1%. Very stable, very consistent, very close to what you had expected your return to be. However, in plan B, look at that volatility. Okay, $30,000 loss, that's not such a big deal, 1% off your target, but $120,000 loss, that's kind of a big deal. Oh, but look at this. I got a nice big offsetting gain of $150,000. So what you're seeing in plan B is much greater volatility. Relating this back to some of the things that Stephen talked about, this could give you some kind of sense of how these two sets of plan assets are invested. Plan A, maybe in a much more conservative portfolio. Plan B, maybe in a much more aggressive portfolio. So the market value of assets in for plan B is higher, as we pointed out. There's a deferred gain of $45,000, which will be recognized over future years. Investment return for plan A appears to be less volatile for returns in plan B. So do the liabilities give us any kind of indication as to what our decision ought to be for asset preference? I mean, it would be easy, it'd be tempting to say, well, I prefer $3 million of market value over 2.9, but will our liabilities give us any idea as to which of these two situations is better? So let's take a closer look at the liabilities for these two plans. Plan A, you see that even though the liability is $4.1 million as it is with plan B, look at how much more of that liability is with active participants in plan A than it is in plan B. And conversely, look at how much more of that liability is with retirees in plan B than it is in plan A. So what? This is now tying into, again, some of the things that Stephen talked about, particularly with respect to glide paths, and how you would look at this just like you would a defined contribution plan. Do I have higher cash flow needs, higher liquidity needs in plan B than I do in plan A? And should that be informing my investment decisions? We have a polling question. Thank you for your responses. The highest, if you don't see the responses, the highest response is that we are confident in our current retirement plan. That's great. I would love to dig deeper in that if it's because A, you have one, B, you have one and it's well funded, and or C, you have one that's well funded and you understand it. That'd be an interesting sub question, if you will, on that polling. But thank you for that feedback. So investment considerations then for when you are considering your defined benefit plan, and if you are in that fiduciary role, or if not, again, if you're with MERS but you want to be a more informed user of the plan, given more liability associated with active members than inactive, plan A has more years over which to fund benefits. So there's more time to recover from poor market returns. Plan A can handle more volatility, just like Stephen was talking about with your defined contribution plan. If you are young, you can be heavy into aggressive investing. If your assets do poorly in a particular year, you can recover in the subsequent year. Something else that will make Plan A different than Plan B, however, is that in Plan A, given how so much of the liability was associated with active participants, that indicates that there are a lot of people still earning benefits. So you will have to contribute higher, you'll have to make contributions to cover those additional benefit accruals. How does that impact your investment decisions? Well, that further can encourage higher return seeking investments because you're already going to be having to dedicate contributions to future benefit accruals. It would be nice if return on investments helped alleviate some of the contribution or funding pressures as well. So that third point, higher return seeking investments could be desirable with less concern for volatility in the situation of Plan A. On the other hand, given higher inactive liability in Plan B, there's going to be higher liquidity demands. And there are fewer years, less time to recover from poor market returns. Benefits paid out will not earn future returns. This is something that needs to be kept in mind when funding a defined benefit plan. I have a client that has a very mature plan, a lot of retirees, and again, these last couple of years were such an anomaly, but going back to 2000 and this past year, in 2000, as you know, the market tanked in March, and then subsequently recovered quite quickly, but not quite like they thought it would for their plan. They were invested aggressively, and sure, they took a big hit in March of 2020. Why didn't they get quite the bounce back they were expecting? Well, they were paying out a ton of benefits during that year. And whatever benefits you pay out when the market's poor, if you're invested aggressively, that money isn't going to earn you anything to recover later on. So the sequence of returns becomes very important when you have high liquidity needs. So again, keeping that in mind can inform your investment decisions for your plan, depending on how mature it is. So less need for future contributions in Plan A because you don't have as many active employees still accruing benefits. So what that could do is contributions that one was used to making to cover additional benefit accruals when it was a very young plan, those can transition into making benefit payments, immediate liquidity, if you will. So if you make $1 million contribution to your plan and you have to pay out $1.5 million to retirees, well, you've got immediately $1 million of liquidity with that contribution, and then you only have to rely on $500,000 coming out of plan assets. So that's something else that one can keep in mind when determining what their particular asset mix is. Knowing that if you contribute at a level that you were familiar with back when it was a very young and active plan, you can utilize those contributions in part towards making benefit payments. So now what if I told you, I'll put these side by side, Plan A, $2.2 million in liability for your actives and just about that much for your term investeds and retirees for liability of $4.1 million. And then I look at my asset gain loss analysis and I see low volatility. Compare that with Plan B, where I have a lot of retiree liability, 3.1 million, showing that I've got, of my 50 total lives covered, 38 of them are in pay status. I have high liquidity needs, but look at that. My Plan B assets are the really volatile ones. That would, if I'm a fiduciary, I might be thinking, you know, the portfolio for Plan B could be a better fit for Plan A, while the portfolio for Plan A would be a better match for Plan B. Now, I'm sure that very few, if any of you, are fiduciaries for two plans. You're probably working on just your plan. So you don't sit there comparing plans A and B and deciding how should I invest in one or how should I invest for the other. But hopefully by putting these two side by side, it gives you an idea of some of the concepts behind the decisions that you're making with respect to your investments. Or more importantly, this last bullet point is that Plan A can eventually become Plan B. Your plan will mature in the same way, and this tying in again to defined contribution plans, if you're in a 403B, a 457, a 401k, that as you age and your liquidity requirements, your liquidity demands become more immediate, that you be thinking in terms of, and Stephen showed it, a glide path, but a target date type of an arrangement where you become a little more conservative, a little more focused on fixed income in order that you can meet those liquidity demands that you have coming up. Let me segue for a minute, and we'll come back to these concepts when we tie this all together. But this question: what is private equity? Does it have a place in your pension plan portfolio? I bring this up because, as a trustee myself, we often are faced with the question: should we have private equity as part of our pension plan investments? As participants in defined contribution plans, there are a number of measures being bandied about that would allow, and I think they might even be in effect now, that allow 401k plans to, in defined contribution plans, to participate in private equity. So I guess, first of all, we need to just step back and ask the question, what is private equity? So in a very broad sense, it's just that, it's private, as opposed to what? Well, if you go out, if you get an E-Trade account, or you go to Schwab, or even your 401k account, those all have publicly traded securities. Apple is publicly traded, Tesla is publicly traded. You can go out and you can buy and sell stock in all these public companies as you want, provided you have the means and the resources and so on and so forth. Private equity is high net worth groups, businesses, some very, very wealthy individuals who want to, who have money to burn, essentially is what it boils down to. There was a company, Theranos. I don't know if you heard it. It's there's a big court trial going on right now over it. But an entrepreneur in Silicon Valley thought, I can develop this system whereby people take their own blood samples and they send it into our lab, and we can tell them everything that's right and everything that's wrong with them based on this blood sample. It's a great idea, instant turnaround. We'll have these kits and everything else. And people, and it didn't go public yet. It wasn't available for just anybody to buy shares in Theranos. They didn't have what they called an initial public offering. But private investors could say, boy, I want a piece of that. I think this could be huge. And so some private investors were able to dump in $1 million, $2 million, what have you, in order to benefit if this thing really breaks out. That's venture capital, if you will. We think this company, this venture, is going to do really well. So we are going to invest in it with the expectation that they're going to knock it out of the park and we're going to do really well. So private equity has potential for huge returns. And it all went south. Turns out it was the founder of Theranos is now being tried for fraud, for selling a product that didn't work, for faking results. There's a big risk involved with it. So private investing can come with huge rewards, but it can also come with risks. And there's such a thing as leveraged private equity. And sometimes your investment advisor will say, well, you know what, we are going to go into some private equity, or we want to make this available to you, but we're not going to do leveraged. That's too risky. We're not going to do venture, excuse me, we're going to do leveraged. What leveraged is, you take a company that's heavily indebted. Let's say half the value of their company they have debt against. And you buy that company and you say, well, why would you invest in that company? Well, if that company turns a 10% profit, that profit as a percent of the portion that is not indebted, that's 20%. If it's half indebted, if it's half not. And that's essentially a 20% return on your investment if you can manage the debt, if the manager of that portfolio can manage the debt while turning that company around. And so the private equity managers will go in and they will manage that company that's heavily indebted and try to turn it around and achieve a nice big fat rate of return. But that leads to the second bullet point here. If somebody starts talking to you about private equity, whether it be in your personal plan or in your defined benefit plan of which you're a fiduciary, make sure that whatever these fanciful expected returns are, make sure that they're telling you what it is net of management fees. Because of the nature of this private equity, as I described it to you, taking over some of these heavily indebted firms and managing them and so forth, those management fees can be very expensive. So make sure that whatever expected return is on that it's net of management fees. And then realize, again, getting back to when I was first giving out some examples like Theranos, for instance, realize that it is very risky. What you are shooting for in high returns, you're taking on with risk as well. With the potential for big wins comes big losses. Also, another thing, it's not easily valued. Sometimes there was an article in the Wall Street Journal, for instance, about a private equity fund that owned apartments in New York City. Well, it's hard to place a value on those apartments. They're only worth what somebody will ultimately pay for them. Well, there are some things you can do with monthly rent, and you can use that to calculate the value of those apartments. So they will have valuation experts take a look and try to ascertain the occupancy of that apartment and attach a value to it accordingly. But getting to this article in the Wall Street Journal, turns out that the owner of these apartments, they were half empty, and he was at night going into the empty ones and turning on the lights, so that when the appraiser was driving by and taking a look and seeing all these lights on, he said, well, this looks to be about 80, 90, close to 100% occupied. If he's getting $2,500 a month in rent for each of these units, I can do the math and figure out the value of that property. And it turns out that the private equity fund that held those apartments was way overvalued. So that's not to scare you. It's just to say private equity as a rule is not easily valued from time to time. Ultimately, it only turns out to be worth what somebody someday pays for it. And that leads to this next bullet point. It's not a ready form of liquidity. With private equity, you got to be in it for the long haul. So if you've got those high liquidity needs, like the Plan B example, where most of the plan participants were retired, most of the liabilities with retirees, private equity isn't where you should be, because you can't, there isn't just a ready open market for Theranos, for instance. At some point in the future, Theranos either had to go public and then start buying and selling shares, and you could then sell yours, or somebody else had to be willing to pay you what you paid into Theranos to begin with, or maybe they issue some kind of dividends and so on and so forth. But so it's not liquid at all. I mean, well, not at all. There is ways to buy it and sell it, but you're going to end up taking a bath if you sell it before maturity. So then one last bullet point on private equity, and we'll move on. But some advisors that I have talked to, when it comes to pension plans, investing in private equity, or even individuals in 401k for that matter, and I'm not giving this advice, I'm just passing it along, is that the good private equity managers don't need your money. It's the managers who are trying to get a start, trying to get into private equity, and they maybe don't know exactly what they're doing. They don't have all the weapons at their disposal that the good private equity managers do. They'll be more than happy to take your money, but that's where, again, you open yourself up to risk. Again, I'm not advising yay or nay. I'm simply pointing out, passing along a statement that an advisor made to me, and that is the good private equity managers don't need your money. So if you get into private equity, there's a good chance you're not getting one of the top-notch investment managers. Some final comments. We touched on this. The sequence of good and bad returns makes a difference, especially when paying out benefits. So if you're young, you have a defined contribution plan, you're not going anywhere, you don't need to sell low and whatever, then sequence of returns is not as big a deal. Down one year, up the next. If you're contributing, it can be a big deal. If you contribute money when the market's down, that's great. It's because the returns are really gonna bump you up when they happen. However, if you're contributing when the market's up and not so much when it's down, it's not gonna be as good. So sequence of returns, when they happen, is important. And that would then tie into defined benefit plans in two ways. One is that if you have high liquidity demands, if you need to make sure your retirees are being paid, you want to make sure you don't have too much in equities, because you don't want to be a forced seller. You don't want to have to buy to sell to get money to pay your retirees when the market's done. So anticipate your liquidity needs for the next 2 or 3 years out and see if you have some fixed income to cover it. I'll use this example, our own personal pension plan here at Watkins Ross, of which I'm responsible in part. In March of 2020, the market tanked, as you know, and our funded status took a huge beating. We were in bad shape on a funded status standpoint, but our investment advisor had been given projected benefit payments for retirees for the next 5 years and had structured our portfolio such that the fixed income in that portfolio, like interest on T-bills and coupons on bonds, call dates and maturity dates of the bond portfolio and so forth, produced the cash when we needed it. So we knew that because we were covered on the liquidity side for the next 5 years, we didn't care. We cared. Nobody likes to see their portfolio tank, but we thought, well, our equities, they'll come back, and hopefully within 5 years. And actually, it didn't take 5, as you know. It happened rather quickly. So that's one thing to consider on the defined benefit side and how it impacts your investments. The other thing to consider is just a contribution. I said this wouldn't be a funding discussion per se in terms of how one contributes, but that sequence of return topic, that sequence of return issue, so many times when I've seen defined benefit plan clients take a hit in the market, and I come back and I tell them, well, you know what? You've got a high contribution requirement. They go, oh, darn, look at the market really tanked. It created this huge contribution requirement. What will we do? What will we do? Or you go ahead and you make that contribution as soon as you can while that market is down. And when it comes back, that compound on the equities you already have is now onto that contribution that you just put in. And in fact, in our particular case, we did it. We said, can we afford to make a contribution? Well, actually, we had to make a contribution. So we did it as soon as we could. And all that market return that occurred on our existing plan assets also occurred on that contribution as well. So things turned around nicely. So never be a forced seller. Know what your liquidity needs are, and have your in conversations with your investment manager, plan accordingly. Couple last points here, and that gets back to that assumed rate of return. I talked about what if it were 10%, what if it was 4%. If a high rate of return is being assumed for your plan in calculating your liabilities, it might look nice from a funded status. And I will say, I have many clients for whom their funded status looks good because of the expected rate of return we're using. And we're not faking it. We got that expected rate of return from the investment advisor, so it's legit. But if we were to assume a more conservative return on investments, the funded status wouldn't look that great. But we might have a better chance of being well funded in the long run because we'd be funding according to a much more conservative position. So the point being is, don't just use an assumed rate of return because of how it might make your funded status look better. Be honest, be open, and look at that plan, that liability, as being a signal to you as to what you need. How well funded are you? Where are you going, and how are you going to get there? So a well-funded plan is one that has an honest and viable plan for paying benefits. And this was one other thing that investment advisor said to me when we were talking. He said, we have never had a 10-year market like the one we've just experienced, and that includes that big tank in March 2020. If your plan has been underfunded and this market didn't fix those problems, funding returns will not be the answer. The temptation is, if you're a DB plan manager and you're looking at an underfunded plan, you say, well, boy, shoot, we can't really afford to contribute to the plan. Maybe return on investments will take care of it. Some plans it did. Some plans became very well funded after this last couple of years. But if yours isn't one of those, and if this last couple of years, if the last 10 years didn't put your funded status where it needed to be, return on investments isn't going to do it. And you've got to start thinking about how to contribute and how to plan accordingly. Got time for polling question. It looks like audit and financial reporting is a hot topic. Just to make a personal pitch on this, I do a lot of GASB reports, so I'd be happy to talk with those, talk with you guys about those too sometime. Or you can call Watkins Ross too. Certainly, or drop me an email. In fact, some of you might even be my clients. But I'm more than happy to talk about financial reporting too. Thank you for your time.
Yes, thank you so much for sharing this great information on government retirement plans, Stephen and Chris. That was great. It doesn't look like we have any additional questions in the Q&A or chat, so this concludes today's program. As we mentioned before, anyone who attended, even if you didn't get a chance to answer the CPE questions, we will give you CPE credit due to our technical difficulties. And if you would like to learn more, please visit Raymond's website at www.raymond.com. You can also email us at publicsector@raymond.com. Thank you and have a great rest of your day.
Thanks, Ashley.